Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 3, Professional Forex Trader, Lesson 2, Economic Reports. This is the agenda for today. At first, we will talk about news and the definition of economic reports. I will show you how to track them using a weekly economic calendar. Then we will investigate the importance of economic reports and why we look at them, followed by how it affects us, whether we are a daily income or a weekly income trader. And at last, we will talk about risk management and how this lesson will set us up for the expert module, where we will go through economics and Forex. Economic reports, in other words, news, is something we as traders love because it creates volatility. In other words, it creates action. So here you can see some economic reports that a lot of investors will look at. And some of them may sound familiar to you also. We have what's called FOMC meetings or FOMC minutes, interest rate decisions, manufacturing PMI, consumer price index, or unemployment rates. While some of the reports may be interesting and important for us to track on a macro level, the impact it will have on price on a micro level is unknown to us. Therefore, in this lesson, we will have to talk about what they are and how we react to them, if we react at all. Before we start, I want you to write down the following statement into your trading plan, because this sums up how we approach them generally on a macro level. News moves price where it was going anyway, in terms of momentum and higher timeframe supply and demand context, only faster. And I will prove this to you with a couple of case studies I've prepared for you, including the Brexit case study. What are economic reports? Economic reports or economic events or news events or just news are on a calendar most of the time. So most of these reports occur knowingly on a certain date and on a certain time. In the world of Forex, these reports will show figures or numbers that usually represent the overall health of an economy, or they talk about monetary policies. This is different to stocks, for example, because in the world of stocks, you will have what is called earnings calls or earnings seasons. Those are reports that typically show figures or numbers that usually represent the overall health of a company. In the world of Forex, we do not care about this unless we choose to trade CFD shares. So some of the economic reports you will find on a calendar are FOMC minutes, FOMC meetings, interest rate decisions, CPI or consumer price index, manufacturing PMI, or unemployment rates. Because we trade global Forex markets, you and I, we don't just care about the reports released in the US, but also the ones that are released for other countries, depending on the currency pair we want to trade. If we are trading the GBP USD, we want to look at the UK. If we are trading USD CAD, we want to look at Canada. So how do we do this? We simply go to investing.com/economic calendar, and here you can easily generate a weekly overview of important economic reports that are relevant to the currency pairs in your watch list, which should be part of your weekly routine. This is what a weekly overview of relevant economic reports may look like. Notice the 3 stars you see under the importance column. This is a pre-filtered overview, so the stars relate to the expected volatility or impact of the economic event. We generally only want to look at 3-star economic events. Let me demonstrate how you would set this up from your side. On investing.com, go to economic calendar at the top right column. Here you will get a pre-filtered daily outlook. What you want to do next is filter on the relevant countries and importance in terms of volatility and impact. For this, click on filters. From here, remove all the countries you don't need and add the ones you need. Australia, we would keep for the Aussie dollar. Brazil, we can remove. Canada, we keep for the USD CAD. China, we can remove. Eurozone, France and Germany, I would keep, as Germany and France are one of the biggest nations in the Eurozone, and therefore their economic data have the biggest financial effect on the euro. Hong Kong, India, and Italy you can remove. Keep Japan for the Japanese yen. Keep New Zealand, Switzerland, UK, and of course the US. This is your starting point. If you're adding currencies to your watch list, you're responsible for ensuring to also add the respective country here. So for example, if you're looking at the Mexican peso as an exotic pair, add Mexico. Or if you're looking to add the Turkish lira as an exotic pair, add Turkey. And now don't forget to filter by importance. Select the 3-star economic reports only. Otherwise, you will be bombarded with events. Go to apply and voila, you can see your customized outlook. Now change the outlook to a weekly outlook. For this, select this week and voila, here you go, your personalized weekly economic outlook. Okay, let's go back to the slides. Here's why we go through this process and track these economic reports. When these figures are released to the public, you should expect increased volatility. Increased volatility for us should be seen as opportunity. This is because most novice traders or market speculators are usually attracted to what is called trading news, and therefore news can be seen as a catalyst. This is generally a good thing because we need volatility for markets to move and make money. Some economic reports cause less volatility spikes than others, and some more. This is a great slide for beginners who've also never looked at news before. Listed are the most important news events we should have on the radar. You can see at the top FOMC meetings, everything to do with monetary policy and future economic outlook of the US economy or the US dollar has a massive effect on most of our forex markets. We have already covered the importance of the US dollar as a reserve currency before and how we use it as a zone qualifier. Also, whenever central bankers, so-called chairmen or presidents of the central banks, speak publicly, we should expect increased volatility. So for example, President Lagarde for the ECB, which would affect the euro. Also important are interest rates. Interest rates we will also cover in another lesson specifically to understand how interest rates do not only affect currencies but entire economies. You also have unemployment rates and many more economic events listed here. But the ones I mentioned are the most important ones. This is going to make your life very, very easy, especially with the weekly economic calendar. You can just check the events with a 3-star and have those on the radar. And if it has anything to do with monetary policy, like FOMC meetings or interest rates, you understand that these are the ones that cause the most volatility. Let's talk about a few interesting observations. Prior to a news event or economic report, volume will go down, meaning participation shrinks, which can be observed in the charts. Once the report is released, you can observe increased volatility, increased participation, but this increased volume will only last for a certain amount of time. Depending on the news event, the reaction can cause an increased volatility that would be considered unsafe for a daily income trader. So if you are new to trading, my recommendation in the beginning is to let those so-called reactions just play out and wait for 15 minutes until you then join in again. Because things can move so fast and violently that you can get into trouble real fast. And our number one goal here is for you to be navigating safely within the financial markets. So now the last question we have to answer is, how do we use them? Well, when it comes to economic reports, we oftentimes speak about the so-called lagging effect. Today's data indicates historic performance of a certain time period. It does not project future price movement. These figures that are reported refer to the prior week, month, or quarter. So the micro price action is difficult to foresee. Positive economic data can cause the markets to go up or down, but also negative economic data can cause the markets to go up or down on a micro level, meaning on 60-minute charts. The macro price action, however, so the higher time frames, this is the macro price action. The macro price action is most of the time in line with the higher timeframe supply and demand context. And this is because influential banks and institutions have sources and analysts to get hold of that data way before it is made public on free websites. And they would position themselves in advance, which are the higher timeframe monthly and weekly supply and demand levels we see in price charts anyway. Therefore, the risk for a daily income trader is medium. This is because on a micro level, meaning on smaller time frames, the increased volatility oftentimes leads to less predictability in the market. We would also refer to this as intraday noise. So if you are a beginner and you trade smaller time frames like daily income, then my recommendation to you is avoid trading during news events and only join back in after the increased volatility calms down. Only if trading weekly time frames or higher, we are allowed to trade during news events because we position ourselves anyways with the higher time frame momentum and direction of price. This lesson is the foundation for some of the lessons we will talk about in the expert module, including economics and forex and how they are connected. We will look at a few economic indicators that are relevant to the forex market. We will also look at the Brexit case study as promised, which shows that charts on a higher time frame will tell you where price is going regardless of news events. Going back to the statement from the beginning, news moves price where it was going anyway in terms of momentum and higher time frame supply and demand context, only faster. And we will also look at interest rates and central banks, what they do and the effect they have on currencies and even economies. But before we do that, we still have to cover a few more risk management topics, including stop loss parameter in the forex market, spread in terms of bid and ask, and gap risk. Alright everyone, I'll catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading, and ciao.